Sir, please start. Agragari sir, please start.
Sir, can we wait for the participants also?
Participant will not be there. This is the Zoom chat Zoom platform. Participants are in a different platform.
Yes, yes.
Started.
Welcome to delegates and participants. I, CALB Agrari, Chairman Gorakhpur branch of CIRC of ICI, on behalf of the Professional Skill Investment Committee, ICI, welcome all the participants in today's webcast. Refine wealth management skill for your own and client professionals. I welcome to today resources Sri Nikhil Lakhani ji and the event enabler of the Gorakhpur branch of CIRC of ICI and other participants over here. I, CLV Agrari, Chairman Gorakhpur branch. Now I invited to CA Vikas Anandji Tejrar of Gorakhpur branch for introduction of speakers.
Namaste sir. Good afternoon everyone. Namaste sir, Lakhani sir.
Namaste ji, namaste.
जी sir. Sir, CA Nikhil Lakhani sir is a distinguished member of our faculty who brings a wealth of knowledge and experience. He is having a vast experience in our academic and professional skills and knowledge. He is also a CA. I already is a CA and also a CPA USA and a CMA. And sir is also running our own practice, and he is having a more experience in also international laws, because sir has already done working in the USA for at least 6 years, I think.
Yes.
Am I correct, sir?
Yes, correct.
Yes, sir. Yes, sir. And sir is also a guest faculty of ICI as a faculty of management and communication skill orientation programs, as well as also in the CMA India, means ICMAI. Also, they are requested to sir to come and give the lectures on the CMA faculty. And sir is also a CFO of Converge India.
I was past.
Yes,
That's
yes.
past.
Okay. And sitting on the board of the several legal entities. Sir is also very dedicated to contribute in the society welfare and social welfare works a lots of, and sir is also very enthusiasm into the yoga, so that we can inspire. Sir, sir, I have already given a lots of lectures in the Gurgaon branch, and NRC has organized a lots of seminars. Sir is also a guest speaker in this, and sir also give the speech in Bangalore, Galgotia University, and also NGO. Sir is a very good speaker, and we are getting lots of knowledge in this term. So I requested you to all persons, please give your valuable time in this meeting, so we will get a very good knowledge and lots of experience with sir. Thank you, sir. Sir, please start.
Thank you, Vikas ji.
Now I request to see Nikhil Lakhani sir for his deliberations.
Thank you, Vikas ji. Thank you, Agrari ji. And also thank you, Sambit ji, for inviting me, and also all the members of the institute who are present here. So today we are going to talk about how we can enhance or we can improve or increase wealth of our own as well as for our clients. Because as a chartered accountant, many of our clients come to us and they talk to us about their savings, investments, and not only saving and investment, but also taxation part of the savings. And many of us have not only resident clients, also have non-resident. So we'll talk about all these things, all these aspects. Few things I have learned from my own experience, few from others' experience. So let us hope we all enjoy. So the first thing we have in increasing or improving the wealth is that there are two things. One is the saving and another is investing. These are the two important part. So we know that saving we all need to do for future contingencies, also for the future of our kids, for our own future. There are many things which we envisage or we want to defer it to tomorrow. Or even if, frankly speaking, we may not end up spending all that in our lifetime. But I always tell everyone that saving is a big question. If you have good savings, at least you are not worried about small things, what if, anxiety and all that. That is why I tell everyone it is not important that you spend all the money you have earned during the lifetime. It is okay, to pass it on to the next generation, because it is our duty to do something good, at least have some good education for them, at least one house for them, and also to take care of their important things like marriage and many other needs they may require, because they look for us many times for support. So two things again, one is the saving. I keep extra money, I buffer it. Investing is also very, very important thing, because our money present value keeps on decreasing year on year because of inflation. In India, we may say that it is around 5, 6, 7%, but for few things it is much higher. For example, real estate, which is actually the really we buy. We really need it. One house, one apartment, one dwelling place we need. We know that it is higher. It is around 12, 14% year on year. Similarly, there are other education is also getting very expensive. So unless our money also, our savings also grow, our money will not have that much of value. We all know that, for example, something which we could buy for, let us say, 1,010 years back, today it may be 2,500. Even for cities like Gurgaon, where I live, the inflation actually is higher than what we see the numbers, because each city may have different numbers. So we need to make sure that we invest in a good way with our own appetite, the way we want it, according to our need. We need to make sure that. So the first mantra around it is that let us increase our active income. Many times what happens is people talk about investment, that this person has become that rich, another person has become that rich because of his investments in stocks or mutual fund. Many influencers talk about it, but we don't talk about our active income. Our active income is, for example, um, I'm a CA professional. So somewhere it may be, my practice or affiliated, associated, where actually I actively work those things, need to increase. So for example, I need to make sure as a chartered accountant that I work hard, I upgrade myself. Maybe I do some new courses, additional courses, so that that is from where actually the corpus or the savings, the more savings will come. Because there is an economic law also, propensity to save keeps on increasing when your income increases. So few days back, someone was talking about Shah Rukh Khan. He has made this much of wealth. I said, he also worked very hard on his active income. Active income is, if you see, he is there almost in every fifth advertisement. He is there on so many shows. He is there in movies. He is there in IPL. So everywhere, if you see, he has investments. Oh, sorry, he is working actively. Then he has investments. For example, it could be real estate. It could be Kolkata Knight Riders. Some businesses, and so like this, he also has some investment. But again, his active income, he has invested in himself. So my request to everyone is that please focus on that. You may be doing a job. If you are doing a job, you can work hard there also, because you know that you will become redundant or useless in your job unless you upgrade yourself. Today we are in an AI environment. Okay, from this is from technology side. And if I go back, let us say within last 10 years, so many things have happened for people who are in the job as well. For example, I would say there has been change in international taxation environment, and India's also new companies act was also implemented. Then we had GST, income tax changes are ongoing. So just imagine if you are doing a job and you are not upgrading yourself, not only from technology side but also from the professional knowledge side as well, you will become useless. So kindly, please, before you work on saving and investing, at least think about increasing, because again, your propensity to save, the more income you will make, yes, government of India would be happy because percentage of your effective rate of your taxation would also go up, but at the same time your savings will also increase drastically. Again, someone making, for example, 20,000 rupees, I can't expect him to save even 20% in Gurgaon. But someone who is making 2 lakh rupees, let us say his effective rate of tax is 25%, and 50, and let us say 50,000, 60,000 he spends, he may have almost 50%, and 50% is huge chunk, 1 lakh rupees. So his base of saving is very high. So please work on your, don't think that you just need to invest. Please increase your active income. And another thing I see many times is people talk about that businesses are better than services. Please, for God's sake, get rid of this thought from your mind. Not everyone is made for business, not everyone is made for job. Yes, we see many big rich people who run their own businesses, including billionaires, but we are not billionaires. Our target is usually to become millionaire. I'm talking about in dollar terms. Let us say around a wealth of 8 crore at least should be a goal or target of every professional. At least that much. I'm saying, they can obviously make more. So in that scenario, there are professionals who are in jobs. For example, I give example of CAs in Gurgaon. It is just my estimate that there are about 7,000 chartered accountants in Gurgaon. My estimate is that at least out of 7,000, 1,500 would be making 1 crore rupees a year. So, and many of them are I'm talking about most of them are in corporate jobs. They are high paid jobs. And they may not be that good in doing the business. So, which is fine. Many businessmen, many professionals, or I would say most, I would rather say, can't make that much of money. So, if you believe that job is good for you and you can have your peace of mind, your savings, your investments managed, please do it. There's nothing wrong in it. I mean, a lot of people just say, oh, no, we need to be in business. Businessmen take a lot of deductions and all that. But businessman has a lot of his own headaches also. Sometimes, from the PN level to the collection level, delivery is, believe me, easier. Even the salesman, even for professionals, getting new client is not that easy. So again, I'm repeating, if you are happy in job and you are getting good money, be happy with it. Don't think that grass is green on the other side, and people who are doing, and other way around also. If you are if you are a professional, you are doing well, then don't think that salaried people have peace of mind. They get fired also, then it is 100% they lose in one day. In this, at least their work, the professional work they lose in one day. Another question arises, debt. Debt is very, very common thing. I am not against debt, but please understand that either you are using debt or debt is using you. I'll give you example. So, for example, I take debt for professional education. Again, we all know that education of different kind of education. I know our institute provides very economical at very economic prices. But at the same time, there are many courses which our professionals are also doing, which are very expensive. If someone is investing and taking debt for that, let us say education, which will give him 50% increase, let us say a job from 25 lakh rupees and end up to 40 lakh, please go for it. But if that is going to get you a better car which your boss is driving, for God's sake, my request is please work on your savings. Because the debt you have got today, you will have to pay, and it will eat all your savings of the future. A car is very simple example. There could be, traveling also. A lot of people travel, EMIs. So again, if you are investing using debt, or for example, you have some proposition or you have some idea where you can safely make more than the rate of debt. For example, you take a housing loan. Housing loan, let us say, comes around 8.4%. And if you believe that with certainty you can make around 12%, obviously this tax thing you also have to pay attention. Around you can make 12%, no harm. But yes, we know that there is risk. But in general, in Indian culture, debt has not been considered great thing in the past. Today, yes, it is acceptable, especially we are now, following Western concept that is okay. That is how their economies are growing. And but my thought is that please remember that what is good for government of India may not be good for you, because government of India's objective is to get more collections of taxes, for example, GST, corporate tax, blah blah blah. And for that they would want, more cars are sold, more travels are happening, because even hotels, I think about 5,000, I don't remember exactly, but you know have 28% GST. Cars, we all know that almost start with 28 and it goes up and up. So, but your objective should be to get wealthy and financially independent. Financially independent, my understanding is that at least you have enough money that you are not too much worried about your active income. At a point, it could reach after 20 years of being a professional, becoming a chartered accountant. It could be 15 years, it could be 25 years. But to my understanding, it should not be that at the age of 60 you reach that, because that is almost forced retirement. My understanding is that even if you are working, you are earning active income, but by around 45 to 50, you should be reaching that wealth level, so that you are not too much worried about losing your job, or your boss nubbing you, or you trying to do something else which you really like, or slogging, which unfortunately we hear a lot in our profession. Slogging in this is, I mean, you're working 12 hours in a day and constantly, not like 1 month in a year, but constantly. I would say 6 to 7 or 8 months in a year, you're working 12 hours, which I believe is not good for you. So please, again, remember that debt use only for something which gives you some benefit, be it educating you or increasing your future income. I again also give example of iPhone. I mean, please buy iPhone if you have ability to buy at least 5 iPhones, and from your own money. For God's sake, don't take EMIs for iPhone. Believe me that normal phone, with the 8 GB RAM or and 128 space, memory space, can do decent job. Yes, it may not give you as good as, pictures to post on Instagram, but it would be fine. Another thing I talk about is, at least have life insurance and medical insurance, because we never know. At least unless we are a couple of $1 million, person, then it may be another story that you have so much of money that you can you take out money, you earn 10, 15, 20 lakh and you are not too much worried. But if you don't have $1 million, please, for God's sake, please buy life insurance, medical insurance, because you never know when medical needs may arise and when someone may die. We have seen it in COVID, but it happens with men more frequently because men are more prone to heart attacks. Unfortunately, we hear it very, very frequently for men, somewhere around 40 to 50, 55. Obviously, later on also it happens, but at this age, we hear at least, to my understanding, it should be 5-7 years of your earning. So please make sure. Medical insurance, again, all type of medical insurance are there, but at least have basic insurance, which gets you 5-7 lakh rupees a year. Another for saving, I say, is please keep liquid assets as well. Not that you have 30,000 rupees savings now, and because market is going up, I know from last few days market has gone down, and we are, I think, at the bottom of the last 2 months, which is fine. I'm sure it will go up. But please, for God's sake, keep at least the next 4-5 months cash expenses, the minimum expenses, I would say, not where you can buy a car with that money, as liquid. Liquid could be, saving bank, or it could be FD, which you can break easily. So at least have that kind of money, so that if anything happens, if you lose job, if something wrong happens in your profession, like COVID happened, so that you don't have to borrow money from people, or personal borrowing, or asking your relatives, because that's not nice. I would say, as a professional, I think it is sad if a professional becoming a CA or anyone has to ask for it, to have at least that much of money. Another thing I talk is need or want, which is somewhere related to the previous examples, that don't get into want. Want, I need many things. I know people who take loan to buy good branded clothes or jewelry. That is want. I mean, I don't need it. I already have clothes, but it gives me happiness, it gives me kick, because a lot of people say that I look good, or at least I have, good pictures in good clothes. But again, my thought is that whatever I buy, at least I should have capability to buy 4, 5, 10 of those things. Only then I buy. And EMI and all that, I would not get into for these things. Many people talk about early retirement. Early retirement seems very fancy. My thought is that please don't think about early retirement. Get into something what we call becoming independent, financially independent, but don't get retired, because retirement is also very boring. Do something meaningful, some money you can make at least. And you never know when things may change. Again, my concept is only that instead of working 12 hours, you may end up working 5 hours, 6 hours, but continue with something. Again, I'm not saying you stick to the profession only. There can be business opportunities, there can be many other things, because let us say around 45, 50, you have enough money, you see more opportunities, but keep yourself busy. And when you think that you have that much of money, please make sure that you estimate whatever your expenditure, cash expenditure, normal expenditure, including some contingency, some travel, some all that. So take your corpus, take around 6 to 8% of the income from that corpus. Don't go for 12%, 15%, because you never know, things may change also. And then you see if that money gives you that monthly expenses, including some inflation creeping in, to live good life. But again, my thought of early retirement or is actually not there. My thought is that you become independent, you do something. Even if you teach someone, you go out, you do some, you know, like even you work on your wealth. There is nothing wrong in spending time on your wealth. One more thing, many time people talk about is one house. You know, one house, a lot of people spend great amount of money on one house. For example, almost 40% of their salary is going to pay EMI of one house. And practically, it is possible. But should you do it? No. Yesterday, I was reading DLF is launching some 10,000 square feet houses in Gurgaon. It would be better than, I don't know which one. There was some Antilla or something like that. I don't pay that attention. 75 to 85 crore rupees, just apartment. 10,000 square feet, which is huge. I'm not saying, I mean, professionals like us can't even imagine, but for example, forget about 75, but see how much money you have. At least you have 30-40% for down payment, and your EMI should not be more than 20%, to my understanding. If your wife is earning, then it does help. There's nothing wrong. I mean, you know, you both are part and parcel of same household. If you both are earning, she's also putting in some money, she understands your pain, then obviously you can increase the appetite. But like, you know, people spend money on carpets, on so much of money, you know, on kitchen, 5577 lakh rupees. You know, from where you are going to get savings and wealth creation if you spend that much of money? Don't worry too much. Someone will come. Someone will not understand your pain that you have to make that much of EMI. Someone will not understand when you will have job trouble. Someone will not give you, someone will actually abandon you also if you are in a bad situation actually. So my request to everyone is, please remain in your limits. To my understanding, second house is an investment. First house is not an investment. First house, yes, it is not an expense. It is an asset, but it is not kind of wealth, you know, on which you can rely when you are in trouble, or when you have to send your kid for, let us say, doing medical or abroad. Also, there is new fashion of sending kids abroad. I'm not sending you, don't send, but you're not going to sell your kitchen or your carpet or your 10 crore house. Another common problem which hinders our saving minimum. For God's sake, credit card only those people should use who can pay it at the end of the month. Even financial institutions or bankers don't like people who pay at the end of the month, because they don't make that much of money. They make money from people who default, who pay hefty interest. Interest, I believe, is around 2% or sometime even more per month. Then there are penalties. And we all know that it is compound interest, how compound interest works. If it is 2%, at least it will end up 30% for the full year. A lot of people get into this points and all that. I personally, you know, believe that spending that much of time for points, again, I'm not discouraging everyone, but my personal view is I don't get into points and all that. Sometime I get 10% discount on my credit card. I take it. I have one credit card, ICICI. I buy dog food. I know 10% immediately, but immediately I pay also. I don't wait for bill to come. At least I know 500 rupees discount I have got something, or I don't mind. But again, personally, many people actually use only debit card. Again, I know a lot of people use points and all that. I believe instead of worrying about points, work on your active income, do your job sincerely, increase your skills, improve your skills, learn new things. You will end up making much more. Same is for personal debt also. Personal debt, we all know that is the rate of interest are very high, and there are traps around it also. We have heard about many applications. Uh, Another thing which we need to keep in mind is, are we paying attention to the long-term investment? Do we have that in our mind? Because many times, again, few investments can only be short-term. If I know my son is going to go to college, which is expensive, let us say medical college or engineering college or studying abroad, and I need it in 1 year, obviously I have to have that horizon in my mind. But I think if you can stay and stick for the long run, be it real estate or stocks or mutual funds, trust me, whatever may be the bull run or bear run, at the end of few years, you will definitely end up making at least 12% income. And my personal experience has been in both. A lot of people criticize rental income. They say that rental income, especially in case of residential, it is very low. But if you have income, you already have invested, there is ongoing appreciation in the price of the real estate asset. From my experience in Gurgaon, and I'm talking like last 25-30 years, it has been at least 12-13%. And we know that unless we realize it, we don't pay taxes. And also taxes, we had indexation we still have for the grandfathering in. And even if I take the new provision 12.5%, tax is much, much lower than our active income or some of the other things. So rental income may be actually 2%, 3%, but it is possible that, please don't compare it with what the value of that capital asset is today. So for example, something I bought 15 years back, and if I compare, I am active in real estate, that is why I'm giving such examples. I have my own assets from where I make such incomes. If you compare at price what which you bought today, the rentals are far higher if you got it constructed. In also real estate, my suggestion is that, flats or apartments usually don't get that much of gain because land portion is only very small in that. For example, it's builder floor, it is only like 4 floors, only 1/4 share you have, because land is where the most appreciation happens. And again, I'm not going to giving you any tip of any particular area, but we all know that some locations, some new projects are coming up. Please keep your eye open. Yes, it requires a lot of money, but if you have it, there is nothing wrong in it. Another important thing I talk about is tax planning. Please keep in mind, tax is income tax, especially, is a big amount. For example, I'm just assuming that most of you must be in 30% plus surcharge is equal to 31.2%. So if you think that something is giving you 10% vis-a-vis something is giving you 8% tax free, I would go for, please calculate those things also for your client. Many times we ignore it. Similarly, like mutual fund, we know that now 12.5% capital gain on real estate, 12.5%. So FD, we know that it pays you around inflation, but at the same time, at which tax rate you are, at least that portion it takes away from the inflation for sure. If you are on 31.2%, then you imagine that around inflation you're getting. So your real value of the asset is even lower now. So tax is again capital gain, like, let me be very frank, capital gain, now we have a 12.5%. I don't encourage anyone to get into black, white, but please make sure try to get white, because now all you have to pay is 12.5%. Even let us say you are selling something, someone who is buying is insisting on cash. My request to everyone is, why do you end up getting cash on which you are not going to earn anything, or which you are not going to invest anywhere, and then again, contravention of the laws and everything. So if you have capital asset, you are selling it, especially in real estate, it still happens in north. It's not a lot, but my request to everyone is to you suggest to your clients also that please try to find someone who can give you full in through banking mode. Pay 12.5% at least. You have money in your, really you have in your hand. So again, saving is important, but investing is even more important, because I have already talked about it, that your money's value will keep on going down because of inflation. But yes, you have to keep in mind your own factors like liquidity, how soon do you need money, how much risk you can take. I would not advise my father to invest all his money in stock market, retirement money. Maybe I would say 20, 30%, 30%. I would advise him to go for stock market. But for others, he can go for easily some government securities where he can get around 8%, or debt fund again are no doubt risky, but relatively less risky. How much return they are coming, time horizon, all these things, factors for different person. A young person may have more risk taking appetite, or a person, let us say around 30, 35, may also have more risk. But please don't put all your money in one kind of investment, say for example real estate, or FDs, or let us say government securities like Kisan Vikas Patra, National Savings Certificate, or everything on shares or mutual fund, because you never know, you may get into trouble also, because things, economy sometimes change also. So my suggestion is, don't put in one source in more than 50% of your savings as investments. So again, liquidity is very, very important. For example, I'm a retired person, and I need as additional money for my monthly income. I'm getting pension, or I may not be getting pension. So most of us are in private sector jobs or doing our own practices. So liquidity is also, monthly income schemes are important, or mutual funds where we can sell, or some dividend income, or corpus keeps on growing and you withdraw something. Let us say mutual funds are growing today by grace of God around, on an average yearly, 12%. So even if you withdraw, let us say 6%, your corpus is still growing. Whereas real estate, if you put money, we know that real estate is usually, to sell is not that easy. Yes, it grows at a good speed. Again, I'm not saying which one grows. From my experience, real estate has done very well if you take horizon of last 30 years. But some of the real estate have gone bad also, in especially in Noida, Greater Noida, Sonipat area. But again, if you need cash, you may get, in a year or so, please don't get into real estate, because you may not find a buyer, or you may have to do a short selling or at a loss. Saving bank, I would honestly not keep much money, because saving bank, I believe, at least keep some FD. If you know that something you don't need for even for 3 months, if you don't need, please transfer it to at least to FD or mutual fund if you know that you can take it out sooner. But mutual fund, I would advise at least for 1 years, because you end up paying less taxes. Again, saving and investments go hand in hand. If you are short at one, you are not going to have great wealth, you or your clients. And now some tips around saving. We all are financially savvy. Start educating your clients also. Clients appreciate, but don't mind taking fees from them for educating them, spending time. It is not that only for tax returns, audits, or tax issues or accounting you get money. Please charge them for the time also. So first important thing is, to me, is know how much expenses you have, including monthly expenses, including one time in a year or some contingency. You please keep a track, create a budget. So unless you have a budget, you don't even know which side you are, either you are saving or not saving. I would say at least have some Excel file. If you can buy some cheap software, do some accounting. I mean, again, we are all are savvy. As we grow, as our investments grow, Excel may not be enough, Tally or some another free softwares. Please have it. Again, please in that also have some buffer for emergency funds. Again, as I mentioned, 4 months, 3 months, 6 months. Also have clear goals, that this much money in once you have budget, you have a income, expenses, have some goals that this is what I want to save and this is what I want to investment, and this much is the wealth I want to create or add during the year. Only when you have some focus, then you can do it. Diversify, I have already mentioned. Don't get into just one thing. Also review and check. If one thing is not working, one way is not working for you, please don't mind, exiting from that investment. Or if you believe that this has reached the peak, exit and buy somewhere where the potential of growth is higher. And now I will talk about some of the investment options which you may already know. I will also talk about, this is primarily for the residents, which again, some of it we already know, but it is better to brush up. Very common thing is public provident fund is for every resident. It's a good retirement saving option. You can have up to 1.5 lakh rupees annually. Initially, it is for 15 years. You can continue to extend it for 5 years after. After 15 years, you just have to do is give a letter. You can do it in a post office or with a bank you can open. Also, PPF now is done electronically as well, so you don't need to be worried about the hassle of going to bank and doing transactions or checks and all that. I don't know about the post office, but for the banks, almost all the banks you can do it. We also know that there is deduction under ATC. From the risk point of view, I would say that it is zero risk. I mean, you can call it low risk, but I would call it zero risk. The greater part is, I think you get around 7.5, 7.75, I don't know exactly, tax free. So just imagine if you gross it up, it would come to around, if with 30% or 31.2%, it will come around 11%. It's not a bad option. I would say have some money there, even if you believe you can earn from stock market 12%, please have, because you will need money, and this is risk-free money, and you never know when things may go down. So at least have some money for your retirement. Similarly, if you are employees provident fund is there, many people go for minimum. I would encourage everyone to have your CTC designed in such a way, and I know CAs have their say in companies' policies and also in the HR policy or pay structure, that at least that bar 12% of the basic, what we have it in employee provident fund rather than minimum. I think it is 5,200, and then you pay 12%. Employee, even if your CT is lower, CTC is obviously the same, but in hand is lower, but you get around 8% tax free. Again, if you gross it up with the tax part, it would at least come to 11+%. And again, you need to have voluntary provident fund. A lot of people do, and these are safe options. Voluntary provident fund is where you can opt for more than what your company is paying. Statutory provident fund or public provident fund. So voluntary is employer deducts extra. It is around 30% you can opt for of your basic. It used to be tax-free. Income from it used to be tax-free. This EPF up to 12%, employee provident fund is, we know that up to 12% of basic is tax-free. VPF, at one point of time, all the income used to be tax-free, but now I believe there are some limitations, like only up to 250,000 you can put in these schemes, and above that, if there is any contribution, you will have to pay tax on that. Mutual funds, I have already talked about. Mutual fund doesn't mean you buy one time. It could be, equity linked saving schemes. It could be monthly investment SIPs, systematic investment plans. The good part of SIP is that the money is invested every month. Sometimes the market may be down, sometimes the market may be up. So that you may buy sometime at lower prices, sometime. So somewhere it evens out. And if you see, mutual funds have given at least around 11.5 to 13% returns in the last 5-7 years. And post-COVID, the returns are actually even higher. And again, but one thing is that their mutual funds have fees. I think the fees goes around 1% to 2% of the fund manager, and it is usually on year basis. I know that sometimes fraud also happen, but still, they end up making good money. So don't worry that someone is making 1.5%, let us say, on an average. That will take away your income, because they are the one professionals, and not everyone has knowledge. If you have good knowledge of stocks or companies and you are willing to take higher level risk, then direct equity, we all know Demat account you have to open. For mutual funds, you don't even have to open Demat account. Direct equity, we all know Demat account we open, we invest in whatever shares, let us say Reliance Industries or TCS or Wipro, whatever, of your choice. These days, you can also do stock buying of foreign companies as well. But again, for that, you have to talk to your consultant, your bankers. They can advise you on that. Again, mutual fund and direct equity have lower rate of, especially if you invest them in them more than 1 year long-term capital gain, we all know that it is 12.5%, which is relatively lower than FD, and usually returns are higher. But for direct equity, you please make sure, because you are going to have your eggs in only limited shares, all your investments are going to be in limited share. You need to make sure that you do great review, and if you don't know, if you don't have time, please leave it on the experts, which is mutual funds or people who manage funds. Real estate I have already talked about. Gold is also not a bad choice, but gold does not give that great returns as compared to mutual fund or direct equity. Gold you can buy, I'm talking about the guineas or the biscuits kind of, not the jewelry, because in case of jewelry, I'm talking about 24 karat, 99.99% whatever purity they talk about. Usually gold gives you more than inflation, or around, I would say, inflation plus 4% at least gold gives you. So again, if you have some extra money, and again, it is hard investment, gold has been there for thousands of years. I believe risk is low. Yes, only risk is fluctuation. Gold, but steadily gold prices have been going up like mutual funds. At some point, you may see that the increase stops for a year or 6 months, but then again, slowly it starts increasing. Just give me a minute. I'll have a glass of water. Just hold on, please. Hello everyone, I'm back. Guys, do you have any question? Feel free to type in or write. We have technical support person who will pass on the questions to me. I don't mind, in between taking 2 minutes break for question answers. If I'm going to discuss it in the next, let us say, around 50 minutes, maybe I'll let you know. Otherwise, we'll talk about it. I guess no. Okay. Then also we have Reserve Bank Gold Bond. It gives you 2.5% fixed income on the investments. It's not like gold they have, it's like bond whose value is pegged to the gold rate. So let us say gold goes up from 70,000, 10 grams to 80,000, your investment will go up in proportion, but you will not have any gold in your hand. Plus you will also get is 2.5% per annum return. And that 2.5% is tax-free. But you need to have at least 5 years investment in that. Many saving schemes the government of India has, which are run through post office saving schemes. Again, don't feel that these are bad schemes. These incomes get you decent income. Almost all the incomes except Sukanya, which is for the girls' education, and when girls grow, maybe you can do marriage of the girl. All these are taxable. They call it low risk, but I would call it zero risk, because government of India, either they print it, the notes or whatever, but at least they will get you the money. Rate of interest is good. There is Kisan Vikas Patra, monthly income schemes, senior citizen schemes, national savings schemes, we all know that these have around 7.5, but it keeps on varying. Higher side, it is around 8%. Even I believe NPS can also be done through the post office. Please remember that this all income you will see in your annual information system. I know I'm talking about the tax thing, but a lot of time your clients would miss that part. They would not tell you that they have all these Kisan Vikas Patra, National Savings Scheme, monthly scheme, senior citizen, or they believe that TDS is deducted, and we all know that all these things are there in now annual information system. Even if there is zero tax deducted, you will see it in annual information system. So please educate client that they will have to end up paying taxes on it. So net return or income would be obviously lower than what they see, depending on their tax rate. But again, these are very safe. Fixed deposits, I would not keep a lot of money, but yes, again, at least 4 or 5 months of my expenses, I would keep. RBI has some insurance also around 5 lakh rupees on each bank's deposit for each person. I would consider it safe because government doesn't want banks to fail because that's core of or backbone of the country. But yes, there is some certain degree of risk in FD. Again, company FDs are there. Company FDs usually pay around 9.5 to 10%, depending on their credit ratings. Again, these are taxables. You have to make sure that the ratings are good, and maybe you do it in debt fund so that the risk is less. In debt fund, there is a fund manager like mutual fund, but instead of equity, they invest in debt or companies FDs. More stable, I would say, because if one goes bad, at least there are others to rely on. Again, these are all taxed at highest rate. Let us say if you are at 30%, 31.2%. Initial public offering IPO, we all know there is big craze, but many times I have seen good subscription goes up to like 100 times. I have heard like many these days, 100 times, 50 times, 60 times. So just think about it, is it beneficial for you to buy it from the open market, or is it more beneficial for you to do initial public offering because possibility of getting good stock is lower? And sometimes again there is also risk, things can go bad also. Unit link insurance plan, ULIP. In this you get some insurance percentage and some investment goes. Long term plan, investment plan, usually the horizon is 10 to 15 years. This also has some GST component because there is insurance GST component, I believe. Effective GST, not that obviously we all know insurance there is 18%, at least for now. There has been discussion to end GST on insurance and life insurance and medical insurances, but as of now there is. So effective because some portion is insurance, some portion investment, comes to around 3-4% at least GST also government takes. And again, this is for 10 to 15 years. Personally, I'm not a big fan of ULIPs because a lot of commission is also paid to the agents. But if you like it, some tax deduction and all that. Bonds are government bonds are also there. Governments, state government, central government, all these bonds we know. Some of them are can be purchased from Reserve Bank of India's portal as well. So less risk, stable income, no harm, FDs. There are some senior citizen savings schemes also. Even in FD, you know that 0.5%, Usually banks pay you more for senior citizens because they know that senior citizens are more stable. They are not at least 0.5% more. Again, these are all tax. Again, highest rate, whatever wherever you are. National pension scheme, to me, people who have in their mind a long-term horizon, in their mind retirement, especially people who are not in the government sector. I know that the armed forces people cannot have NPS, but people with the private jobs and people who professionals also can get additional deduction of 50,000 under ATCCA or B, something like that. So there is no harm. 60%. This is exempt when you deposit up to, let us say, 50,000, or NPS employer portion could be up to 10% of the basic salary. But again, you can also do additional top up 50,000 from your pocket. That is exempt additionally, whatever ATCC A or B, over and above 1.5 lakh rupees. Exempt, let us say, when you invest, exempt income also. But when you actually get the money, 60% is what you get accumulated, so that is tax free, but 40% you will receive as pension. That would be like your regular salary, taxable in the salary heads, so that would be taxed. But I had once done math, at least it gives you 50% more income than regular FDs, because there's tax as well, and you have to pay immediately NPS, at least taxes at the end. And FD, I mean, again, I know ATC is there, but usually less than 5 years, you don't get any exemption, tax exemption also. Monthly income, provident fund, employee, Atal Pension Yojana is also there, but this is for poor people, unorganized sector people. Minimum is 1,000, 2,000, 3,000, 5,000 per month you can invest till the age of 60. Depending on the contribution you have made, you will get money. These all are more or less, you have to pay taxes. Though in Atal Pension Yojana, I doubt people would be in tax brackets. Sukanya Samriddhi Yojana, I would say people who have daughters must invest in it. You get around 8% tax-free income. This is tax-free, please remember that. And whatever we may say, I am a big proponent that women should study, women should be independent, women should do their job. That is how economies grow, that is how countries grow, that is how society grows. But we know that for girls, we have to do some expenses. For education, we have to do for all. And again, this is 8% tax free. Guys, what for you're making up to 1 lakh rupees, 1.5 lakh rupees, you can invest. ATC deductions you will also get. Interest is also tax free. Maturity is also EEE, what is called exempt, and when you receive it also is exempt. So my request to everyone is, those who have daughters, you can use it for education or for their marriage. We all know that we have to do it. Even if it was available for boys, I have a boy, I would do it, because we all know that this education and other things, we have to invest. A recurring deposit is like monthly, you have some deposits, you invest. I don't see anything wrong in it. If you are regularly making some income, it is like SIPs and mutual funds. This is with banks or with post office, nothing wrong with it. Please do it. Corporates, bonds, I have already talked about it. These have higher risk. around 9.5% interest you can make. Real estate investment trust. Real estate investment trust is basically, these are bonds or papers, or not bonds, basically kind of stocks of real estate companies that operate real estate across the sector. If you are very keen in real estate but you don't have 1 crore, 2 crore, or 5 crore rupees, at least you can buy their shares, or they have investment in real estate, so you may get a small portion of it. Portfolio is diversified, capital appreciation is also there, inflation more or less you will easily beat. So this I think is a good option. Kisan Vikas Patra had a system. I have talked about SIP. I have talked about. So please understand, before you choose any of these investments, please make sure that you understand your financial goals. You need money to buy home. You need money. You may need it for short term, long term, to buy a home, education. Let us say you may invest for, let us say your son or daughter is in second class. You need it for till 12th class. Maybe nothing wrong in it. 10 years, 10 years, 12 years, you can invest. You're doing it for retirement, like PPF, EPF, VPF, National Pension Scheme. Please have some money. You never know. You may need all that money. The risk, if you get nervous with small increase or decrease very fast, don't take risk. Because I don't want person's heartbeat to go up, blood pressure to go up, and then get into health related problems. If you can buy stocks or buy mutual fund and don't worry about it on daily basis, let us say once in a month you see their NAV or increase, then it is fine. But if you are daily, you are seeing it, you're not feeling comfortable, or you're feeling very excited, frankly speaking, if you get very happy with small increase, you will also feel very bad when there is small decrease. So personally, I believe that a person needs to work on their personality. Just take it easy. All these fluctuations are there. Usually long term increases are there on good investments. Time horizon, again, I would say, please have long term time horizon. Chances are high that you will end up gaining. Do your research. Please don't rely 100% on these fund managers. Do your own research. At least do on how each fund is performing, how, let us say, real estate, how each and every investment is doing. Understand the tax part. Again, we are all chartered accountants. Even understanding the tax issue, you may end up, actually getting good extra. I mean, if it is tax exempt, or let us say, as I mentioned, 12.5% on capital gains, long-term capital gains. That's a great thing to save. Where you are investing, can you get out of it soon? Risk, all these things, research, diversification, I have already talked about. Don't do just stocks or bonds or mutual funds or real estate or only FD, or just have some mix and match of everything. Professional guidance, if you need professional guidance, seek it. We have, I'm sure in your town, in your city, you will have fund managers, agents. They can guide you, but use your also brain. If they are honest, try to see it through some documents rather than just blind faith trusting them. But if somebody is saying 30%, 40% return from short selling, hedging, and all that, personally, I don't believe in that. These are very risky and very dangerous propositions. You may end up losing also. Short sellings, hedging, puts, all these things are, to me, these are dangerous games. It's up to you. Again, how much cost is there? How much fees is there? Many agents share also. They give you at least 50% of their commission. No harm in knowing it. If this is the market trend, this is what I'm not saying. You rip them off, you take them money, their hard-earned money. But if that is what they are doing with others, or if this is what is there in the investment, then do it. Like post office schemes, almost all of them have some agents giving you back 0.5%. Similarly, mutual funds, no harm. Again, if you don't have time, then at least monthly you monitor it and adjust your thoughts, or whatever you want to choose on regular basis. Don't just sit on one thing that you have done something real estate. For example, I invested in some real estate in Delhi. It was going in losses for 10 years. Nothing had happened. Even before inflation, I was in loss. Even before taking into inflation, no interest, nothing, I was in loss. But after 10 years, I ran out of my patience. I sold it. I thought better get off. Again, out of 10, 2 investments go bad for me as well. And it's okay. So guys, this was around the Indian investments for residents. If you have, I'll now go to the next topic, which is on around NRI investments. If you have any question, please feel free to ask. Otherwise, we'll go for the NRI ones. I'm just pausing for a minute or so. Our technical person or someone who is receiving, I know that is a different platform, I don't see it. But if they can copy paste any questions, I'm just pausing for a minute or two. Again, I'm repeating, don't think that you will become rich only from investments. You need to have active income, put in active income and invest in yourself. Okay, guys, I don't see any questions so far. So let me go back to the NRIs related investments. Many of us have NRI friends, relatives, or clients. NRIs cannot invest in everything. So, for example, NRI cannot invest in agricultural land. So, you need to know before you give them an option or proposal. Please make sure that you know what are those extra things NRIs have to do, what are those extra documents. Do they need to have NRO account? Do they need to have NRE account? Or can they have ordinary saving account? Many people, many clients, relatives have the local resident accounts. As per RBI, it is not permitted. It is not permitted. So please tell your clients that they need to make sure that they move to at least non-resident ordinary accounts or NRE, or at least not for their local money they have. Another important part is sometimes the tax part. So, for example, something is tax-free in India, but is it also tax-free in their home country? Because in their home country, they may have taxes. For example, US, in US, a resident has to pay taxes. For example, H-1B visa, person who is living there, working a job, doing a job, or L-1B visa. I'm not talking about green card, obviously, is a resident, but citizen is also a resident. But for example, they have to pay taxes there. So even if in India they get something tax-free, that tax treaties also have to be paid attention. Or at least tell them that check the option of taxes in their home country also, so that we don't look fool, or at least we don't give wrong advice just on the basis of the local Indian taxes, because a lot of NRIs have investments in India. So again, we know that there are many NRIs have deposits, FDs, bank deposits through FCNR, non-resident ordinary, non-resident accounts. So I'll talk about what those accounts are usually. So at least understand. Non-resident, one is non-resident external. Non-resident external is allowed to NRIs to invest their foreign income in India. And this is in, please remember, NRE, external. The money is in INR, the dollar is converted, dollar or whatever foreign currency is converted into INR. The income they earn is tax-free in India, but again, in their country, they may have to pay, because I remember I had been in the US. I had some NRE deposits, but I had to pay tax in the US on those. But again, the currency risk is there, because this money is converted. Yes, usually on INR you get more, that is why you invest. But the dollar, slowly, if you see over the long run, at least 3, 4, 5% every year it goes up. So that risk will always remain there. Principal can be repatriated, interest can also be repatriated. Again, interest is exempt. Person can open through single, jointly, or person of Indian origin. Again, deposit is made in Indian rupees. This can be closed anytime, like ordinary FD, but again, this is called non-resident external account. Tenure is from 1 year to 10 years. Sometime if they need some loan, they also allow, banks also, like on our FD, allow. Interest rate varies. Usually it is around the same what we get in India on FDs. There are many banks who do it online. Non-resident does not need to come to India to do these deposits. They can manage it from there. They can online, everything is done. Then there is fixed deposit in Anoro, non-resident ordinary. Please remember that one was external. This is ordinary deposits are way of non-resident Indians to manage their income and deposit earned in India. For example, a person has shares, mutual funds, or real estate assets, rental assets in India. They are earning income from there. So again, they cannot have the normal, the one we know, saving account. They need to have his non-resident ordinary account for Indian income. This is from the source of the income is Indian. This money, rental income, interest income, pension, people have dividend income, FD interest, all these things would be deposited there. They can withdraw it online. They can repatriate it. Obviously, foreign currency fluctuation would be there. TDS is also deducted usually on these income around 31.12%, if I am correct. Please again remember DTA, double taxation avoidance agreement, at least look at it, or at least suggest client that they need to check on these things. Repatriation, there is usually a limitation up to $1 million. You can do it in one financial year. Then fixed deposit also you can do it in FCNR, foreign currency, non-resident deposits. In this situation, foreign currency. So for example, you have dollar and the money, the denomination of the account is also, this FD is also in dollar. $1,000. It can be GB pound, it can be euro, it can be Australian dollar, Canadian dollar, Hong Kong dollar, Singapore dollar, Swiss franc, and Japanese yen. I think there is some limitation. Again, that particular currency would remain only in that currency. There would be no up and down, increase or decrease or fluctuation in the foreign currency, but rate of interest now are lower. Please remember that. You cannot expect that you will get higher rate of interest. Long back, I remember I was in UAE, and that time India did nuclear test, and India asked for dollar denomination account deposits, this FCNR, and they're giving 8% rate of interest, tax free. But that time India really needed foreign currency. Today we are not in that situation. Today even the local currency account we don't get 8%. It is somewhere around 3 to 4% these days. Tax benefit again is there. Repatriation can be done, but foreign, the tax in your resident country has to be taken place. Loan can be taken, auto renewal, all those things are there. NPS is also available for NRIs. Please remember that. But for this, you need to have PAN card, Aadhaar card, so they can continue. Again, NPS has its own limitation. How much maximum you can have in equity? It's about 75%. Usually it is mix of corporate bonds, equity, government securities. So if your client wants to retire, come back in India, they can do it. Before 60, you cannot withdraw much, only 20%. There is also type A, type B. Type B, I believe you can withdraw completely, but you don't get any tax benefit like what we have been discussing. And again, 60% accumulation of the corpus at the time of retirement, 40% you will get at the normal pension. NRIs can also invest in direct equity. Obviously, they have to worry about the laws of their own country. Usually, the limit is 10% of paid up capital of an Indian company. It can be increased up to 24% if the company's general body approves it through special resolution. But usually, you can see that it is only 10%. That is company's responsibility. Again, if you are aggressive client likes it, he believes in Indian market, usually it is through portfolio investments or FIIs, but this is also real estate also. Investment can be done by NRIs. As I mentioned, TDS is very high, 31% or something like that. And also, again, tax return has to be done to get the refund, or 195 lower rate of deduction. Same is for the rental also. Usually the TDS has to be around 31.2%. Irrespective of the money NRI is getting, the amount is not a threshold here. It's not like 50,000 a month or anything like that. Nothing like that. It starts from zero. So TDS are high again, unless you go for 195 lower rate of deduction. Again, agriculture and plantation you cannot do as NRI. Mutual funds also available. There are asset management companies. They have restrictions. There are restrictions on NRI investments from US, Canada, and some other countries. Please remember that before it is actually done, at least that needs to be paid, that if there are some restrictions from investment in that country. PPF, I have already talked about. PPF can also be done by NRI, but only when he has been a resident. Once he becomes a non-resident, he does not need to withdraw money, but he cannot extend it. Like for after 15 years, he cannot extend it for another 5 years, but he can continue with contribution up to 15 years. maturity, withdrawal, more or less same. Tax free. Again, employee, lot of employees, NRI employees are working in India. It is mandatory for them if they are non-resident or foreign citizens, let us say working in international multinational company, they still have to employee provident fund if it is applicable. It is must. They have to wait for 58 or 60 years before the retirement happens. I think it is 58. So all those rules are applicable. They're gonna take back. So as NRI, non-resident, or even a foreigner, if he comes to India, no relationship with India before, he has to comply with all these. So this was around the NRI ones. I see a lot of questions. Maybe we can take some questions around it. Let us see. Sir, I am sharing question. How to improvise my wealth? Even earning is not enough for my basic needs. Sir, this is a very good question. So I believe all these are different questions. Let me go by how to improve. This is a very good question. That is what I am saying, that please increase your active income, invest in yourself, do some new courses, upgrade yourself, because you need to have basic needs. If you are making 20,000, 30,000, 40,000, possibilities high that you have no savings, and I cannot say that you need to have 20% savings. I will be foolish if I say that you need to have 20% saving. So increase your potential, do some courses, or invest in yourself basically. Even if it is not a formal course, personality development, writing skills, upgrade yourself, update yourself. Even if you are not going to some new or formal college, please do it. I don't see there is any other way of increasing. Only then you can, propensity to save increases when your income increases. Another question is why you said money in FD for 3 months. I believe FD is better to get easily withdrawn. Please avoid. So I mean to say was that if you have FD, you can withdraw it easily. I'm honestly not sure about your question. You can easily withdraw it if you. I mean, 3 months it would be better than saving bank. 3.5%. I believe SBI is giving you 2.7%, which is very bad. So at least you'll get 5%. So withdraw it. I mean, if you want to do it for a few months in stocks, again, short-term capital gain you have to pay. Sir, can we buy? Yes. Gold ETF bonds. Yes, through it is done through RBI. You can also do it through RBI site. Also, there are portfolio managers who can help you. Even those agents, you talk to your local agents, they can do it. I don't know. Again, I'm very frank and honest. If you get some commission back, get it. Why not? Please, would you talk about investment advice for senior citizens? As I mentioned, senior citizens also can invest obviously in all these options, but I would not call that senior citizen go for very long-term horizon. For example, like real estate, I would say now enjoy, because real estate requires a lot of money. But for example, senior citizen deposits we have with post office, I just mentioned, talked about it. Again, you have to pay taxes. My suggestion is, if senior citizen is little aggressive, he can take risk, he or she can take risk. Why not have 30% at least mutual funds, or if they have understanding and direct in equity? Yes, why not? They must have it. I mean, but again, even frankly speaking, my father is 80. I still believe he has PPF account. He has tax deduction and tax-free income. Tax-free income, if you get at least for senior citizen, I would say please go for it. Nothing wrong in it. At least it is almost equivalent to 11% of with tax income. Sir, how can we build corpus through stocks? Which sectors we invest in? Which mutual funds are given the best return? Honestly, I would not suggest particular one, but for example, if you don't want to take a lot of risk, you believe in index, then BSC, BSC 50, Nifty 30, all these, are there. Some of the mutual funds are like mixed, they will have it from all the sectors. So the risk is low. Then there are mutual funds which are only large cap, only small cap, only the mid size. Depends on what is. I would not name anyone, but if someone is going more or less, all these mutual funds have, there is a boutique of 50 stocks and they all buy those stocks. They are very smart. They don't want to take risk because they don't want to be punished for losses or too much of risk. If you see all these, again, please do your research. If you see all these bonds, mutual funds, mutual funds, they give you around 11.5 to 13%. How about investment in short-term fixed deposit in a bank? Sir, nothing wrong. If you have some money, I have already talked about it, 3 months, 4 months, 5 months, do it. Hi, sir, bonds with lock-in period 2 years or going for mutual fund. See, again, if you don't have any risk taking appetite, then obviously go for bonds. But some of the bonds or debt funds, basically, government, oh, sorry, you are talking about bonds. Government bonds, to my understanding, are risk free. If you don't want to take risk, your parents don't want to take risk, nothing wrong. Even I have, why lie? I also have some portfolio of my own in government bonds. But mutual fund these days are doing well. Right now, stock market is at 2 months low. I don't see any reason that you should not be investing it. Chit fund. I find chit fund honestly very risky. I don't know. I mean, I would not suggest chit fund, but if you know some reliable, that's very good. How reliable the investment advice given on business news channels? Let me be very honest and upfront. Some of them are vested. They have vested interest. I wouldn't worry about taking tips. Do your own research. I believe they are connected, usually connected to one or another one. Sometimes they have their own stake in that. But if you genuinely believe, do some your own research, I would say. Take tip from them, but do your own research. Or this is what I can say. For example, I take advice, but I do only what I feel is good. I do whatever I feel finally makes sense. Even, for example, my father says me anything. I'm grown up and old enough, honestly, but still I listen only when I believe that my father is saying right. When believe he's not right, I just simply say no. I mean, you are the best judge for yourself. Final, it should be your decision, and no one can think about you better than you. Another question is, sir, please share the benefit which NRI have over taking insurance from LIC or any other Indian insurance, taking insurance in country where they are staying, or in other words, I cannot read actually. What good for NRI taking insurance? Frankly speaking, Indian insurance are very complicated. I don't know how many insurance companies allow NRIs. My request is you weigh what is there in your country. Because in India, objections or issues are sometimes very high. And again, I'm not saying that it is bad. Same maybe in their home country also. Cost benefit, payout ratio, claim payout ratio, all these things, you need to check. Personally, my advice would be for the peace of mind, NRI should, unless insurance in the form of investment, like LIC, where there is investment and insurance, then LIC may be a good option. But if it is purely insurance, for example, if anything happens, you pay like $300 $200 in a year, you get a lot of money. So then it is a purely insurance component. So first you have to see is either you want investment and insurance both, or only insurance, and then see if your country provides better option. Can you please explain about reserve mortgage and its utility for senior citizens with the limited? I'll be very, very honest. I have not understood question, or maybe I don't even know the answer. I'll be very honest. Maybe separately, I'll write my number here. If someone can connect with me, maybe more explanation. But so far, either honestly, I don't have answer or I don't have understood the question. Okay, guys. So we have run out of questions for now. Here is my number. Again, whatever good advice I can give you. I am not connected to any portfolio or any. I'm just doing it because I like giving knowledge back to the society what I learned. I have personal no stake. I don't even name, especially the private ones and all that. But you all have agents. You all know through one or another sources, people who are managing fund. A lot of people reach out to me also. Think about them. Okay, sir. This is part is almost done. Then small thing I may talk about is financial independence, early retirement. Sir, a lot of people talk about it. A lot of influencer talk about it. I may sound like a spiritual person. There is no harm. See, being financially independent, I always tell everyone that make it an objective that you need to be financially independent. Again, financially independent to me means that I have enough money corpus that now my active income is less than 50% or even less than my investment income. I'm not saying it, I would not call it passive income, because sometimes you're actually working on investments seriously as well, spending time. Even I do it on, especially some of the real estate rental. I have decent rental income. I work on it. I work on construction. I work on finding tenants. I work on a lot of things. I refurbishment, redoing a lot of, so I spend at least 5-7 days in that. So retirement, I would not call it zero, that you stop doing anything, watching TV only. Do something meaningful. Financial independence, yes, you must have it so that you can enjoy your life. In layman language, I joke with people that we are not donkeys. We are here to do something meaningful. Meaningful means it could be anything, doing something, giving back to the society as well. But that all is possible, or spending time with your kids or your family, which most of professionals cannot do it for one or another reason. And unfortunately, that time never comes. And again, I'm not saying you can meet or you can give your time to everyone all the time, but at least you have some time. At least some friend, some people, some relative, your children at least you should be able to. If so, that idea, if you have in mind, yes, again, you need to have a lot of money, but again, you need to make sure that don't expect that you will get 12% income from your corpus. Expect around in the range of 8%, I would say, is fair. And if you ask me, after tax, I would say calculate around 7%. Again, I know effective rate could be 20, 30, whatever. God willing, you even have to pay surcharge, become rich. But sitting idle and doing nothing is not a good option, because then you start losing the meaning of life. Sometimes you become sick unless you go regularly to gym, do exercise, which all of us must do at any age. Even I go to gym with my son, and I have been very active in doing exercises. So again, my request is that please have some goals in writing, have your expenses in writing. Excel, once you are in the range of, to me, 5-7 crore rupees, and you have a good portfolio, please have some accounting software to do your expenses. Again, I'm not saying that you every 10 rupees you buy do something, but at least some bulk part, number. You need to have idea. You need to do what transactions are happening in your account, because frauds happen, wrong things happen. For your planning, for your tax planning, for your investments, you can not that you see everything from your annual information system, because something is not even taxable. For example, your income is maybe taxable income is not growing, but your wealth is growing. For example, real estate. I have some real estates which have grown over years. So I don't pay tax because it is not realized. But you need to have some good idea that where you stand, how much wealth you have, how much income you are making from those. And this again, you effectively, correctly, once your portfolio grows, you can do it only on a accounting software. I'm not talking about ERP, some basic accounting software. Even if I don't know for free, I also have one software which once I purchased from the US. But whatever you have something for retirement as well. Have something for yourself also. Please don't keep every money for your kids, because you never know, they may turn their back. I'm not saying that it will happen, but it does happen to many. I personally know it. I would rather be in a situation where I leave some money for them at the end than having everything for them in the beginning, or giving them. Don't get into a habit of looking at people, how what your bosses are doing, what other is doing, because that is what is really killing. I believe you know we have run away from our own philosophies, our own Indian philosophy, where people used to buy things based on need, not on want. And I know government of India's goal would not be fulfilled with GST, but that is not your goal. That is government of India's goals can be different. You spend only when you have, especially on your personal expenses, only when you have money. And again, every month at least, being chartered accountant, I would say, do some reconciliation math, where you stand, even if it means couple of hours, and see the progress, how much your wealth has grown over a year on year, and see where things are going wrong. See your balance sheet. And I'm talking about accounting, nothing wrong in it. Unless you spend time on anything, unless you focus on something, you will not be able to generate wealth. And if you are not able to generate wealth for yourself, chances are very high you would not be doing a justice to your clients as well. So guys, with this, I will end my session, but your question answers, I am open. I know a lot of good questions have been asked. I tried to answer them. But if you have more questions, please feel free. Sir, Sambit sir, Vikas sir, and there are other people, and I know there we have technical support. They copy paste from different platform. I cannot see anything. But again, if someone wants to reach me, they can reach me on WhatsApp. Is easier. Calling sometimes is, you don't know who is calling you. It's harder. But again, my discussion would be around more generally guiding you on principles. I talk on many soft skills. So please feel free to reach out to me. Yes, sir. Open for question answer.
Sir, can I ask one question?
Yes, please, Vikas ji.
Sir, if I want to take a loan of assume that 50 lakh rupees, then average rate of interest is 10 to 12%. And if I again invest same amount in the mutual fund, like, then they are assuring that the 20%, at least 20% average income, then can I invest into the mutual fund, and thereafter I can meet out the interest expenses through the mutual fund income? and rest 10% are at least 8% will be left to me, which will be beneficial for me.
Vikazi, honestly, 12% is very high. If you get 12%, I would say if you are getting something at 8 and you are at least
8 is only for
eight,
the
eight
house
and a
property,
half.
sorry,
If you are
housing
getting
loans.
interest at 8 and a half, and investing, see, 20% is very optimistic
Okay.
because to my understanding, if you see long run to me is I am 53. So long run to me is almost like 33 years.
Yes, sir.
So if I see all those long run, the returns have not been that high. Let me be very honest and frank. I
Okay.
know bull run is there.
Initially, still they are giving a
India,
higher
it is.
return, but
I'm sorry, sir.
nowadays.
I'm saying I would say 20% is very far fetched and unreasonable to expect. But if you think that 8% and I think it represents still very high, around 5-6%, let us say, and taking into consider tax also reduce something, you can do it. But I would not do a lot because you also have to worry that if something goes wrong, then what
Yeah.
happens? So
Yes.
do it only what you can bear, especially when you have taken the loan,
Yes.
right, sir?
Yes, sir.
Sir,
Thank you, sir.
thank you, sir. There are some questions. Is it good to invest in corporates, secured debentures, and how to understand the rating assigned to them as there is no standard terminology prescribed by? You are right, sir. I don't know who is the person. I don't see the name. Sir, you are right. There is no particular prescribed standard or structure around ratings, but usually the bond papers, they have like 10, 20 at least corporate bonds, debt funds. They have, they mitigate the risk. It is decent. Personally, I have not gained a lot. Let me be very, very frank on my own experience. I have not really gained a lot. I would simply go for mutual fund these days because risk is still there. And again, I'm very frank. I have not gained. I have also done investment in debt funds. They say they claim more, but somehow, effectively, something or another, some bad debts happen. Something, some small portion, obviously, because they have invested in 10, 20 funds. But yes, chances are high that they will give you more than FD. Sometimes they have some equity inbuilt in that. So if you have equity built in that to the extent that you get benefit of equity and 12.5%, then at least that situation would also help increasing your net cash flow. So think about it. But I would rather say go for mutual funds. Okay, next is having accumulated good asset portfolio at the end of your life. How do you arrange to properly dispose it, transfer it of your asset after your death? What are the meaning which will ensure smooth transfer with least legal issues? So I would say, sir, please have will. Will is very, very important. And again, I'm not expert of will, but you don't need to get registered will. And the last date, let us say you can have 10 wills also, the one which has the last date is considered valid. But if you better get registered so that it is with the government as registrar's office, you better get it registered. I would say at least have nominees, joint name of the people in some of the assets, some of the big assets. For example, let me be very honest, on my wife name is there almost in joint all assets. And then I also have nominee as my son. So chances are very, very high that it will not go wrong. At least, legal transfer should be easier ones. But have a will, have it writing, sign it, and better get it registered. But again, registration is not mandatory. I hope it answered the question. Sir, how can one improve in writing? Also, what are the future prospect of it as chartered account writing? I believe you are just talking about writing skills, right? Okay, this is not related to investment, but believe me, the writing skills are very, very important. This is off, but I will still talk because I like to talk about it. See, writing skills, I tell everyone, we are in a country where unfortunately our own language does not have any value, especially in our profession. In the sense, yes, we can talk in Hindi, smooth talker, but quite frankly, like even in this seminar, I am very good in Hindi, Punjabi, but I am supposed to speak in English, right? So similarly, you will go to many platforms. You work for big companies, multinationals. So please focus on writing. I tell everyone, have understanding of basic grammar like tenses. I know I'm deviating, but this is what the question is asked. Tenses, modal verbs. See some YouTube videos for 10th class. Spend 4 or 5 hours. This is investment. Believe me, and this will increase your active earning. If you are working in a big firm, big company, or if you want to have more lucrative clients, we all know that this English language, you love it or you hate it. Not that I love it, I'm talking, but we have to be better at it. Even I write on WhatsApp, I write good English. Good in the sense, not like Shakespearean English or Shashi Tharoor kind of English, but I try to write neat, decent English. I write some blogs. I write on social media. I try to write. Only then my reports will improve. Only then my emails will improve. But just to start with, even on this WhatsApp or personal chats or whatever you are doing, try to write as good as possible. And this tenses, modal verbs, preposition, these will not take more than 5 hours. Please spend some time on it. It will improve everywhere your English. Yes, sir. Next question. Anyone has any other question? No. Sir, maybe we can close it.
Sir, one question, please.
Yes, please.
Sir, REIT, REIT, Reinvestment Trust,
Real
concept
estate.
given by the government. Yes, sir.
Yes,
Can
sir.
it is viable in the future, sir? Can we invest in the REIT or InvIT
Sir,
stocks?
Sir, personally, if you are emotional about real estate, then it is another question. Otherwise,
No.
I would say, unless you have some emotions tied to it and you cannot buy a land or apartment, I don't advise anyone for wealth or investments. But otherwise, I would say keep yourself open. Yes, REIT has given decent returns, but sometime it is not up to the mark. My suggestion is try some other type of technology or companies as well. I am not big fan of RET.
Okay, sir. Sir, can you suggest us which type of investment is more beneficial? 100% guaranteed return will give, except debt fund or a bond or a FDR.
100%. How can anyone say? Only God knows. If you are almost saying
Like
that if I will be
some
alive,
of the
if I will be
stocks.
alive after 2 years, I don't know. There is risk and reward are always connected. See,
Yes, sir, yes,
whatever
sir.
mutual funds and everything I'm saying, so far economy seems good. Our price earning ratio is also decent. Globally, we stand at a decent place. Economy is growing, country is growing, economy seems stable. I still believe mutual fund or direct investment in equity would give you, again, if you really are very simple person, don't want to take any kind of risk, then go for PPF. At least 1,50,000 NPS, at least tax free. You will at least around, including tax, if
But
I do
it have some block of period, like 3 year or 5 years, so that the money will be get stuck into that funds.
I would say go for find some good mutual fund manager.
Yes, sir.
He will guide you. Trust me, you should gain. I am expecting at least 15%. But again, expecting, this word is expecting. There is no certainty, trust me.
Yes, sir. Yes, sir. Yes, sir.
And you can invest anything. For example, 2,000 rupees per month also, if you don't have extra money. If you have, obviously, you can do 2 lakh rupees per month also. But if you don't have, you can do two. The beauty of the mutual fund or SIP is that you can do it a small amount also every month. And the risk also is mitigated.
Sir, can we invest into the companies who are dealing in the gold? Because in this time, gold and silver rate is so much high. and the media and lots of experience holders person are saying that it will be go to the near about in this time it is 80,000 approximately 82,000 and
Yes, yes,
it will be go to the double just in 1 hour 1 year.
I doubt honestly. They, these all things have always been talked about. I see growth there. Again, if you see long term horizon, 10 years, let us say, you will see inflation plus 4-5% growth. But you may not see like mutual fund kind of growth. But yes, you will see this. Then buy RBI bonds. They will give you gold, gold connected
Gold
indexation
virgin
kind
bond
of,
and like
yeah,
this.
sovereign bond, and 2.5% they will give you otherwise also. Do it. Capital gain also you will get only 12.5% tax, and I believe 2.5% is exempt. I also have investment in that.
Yes, sir. Great, sir. Yes, sir.
Anything else, sir?
From my side, it is complete. Anyone else can ask.
I see no question. Technical support sir is saying no question.
Sir, if there is no question, then now can proceed further.
Yeah, and before, I don't know if I get chance. Thank you very much, all. You spent 2 hours with me. Trust me, time is most important thing, and you gave me 2 hours, so I should be thankful to you.
Sir, I'm requesting to see Vikas Anandji, Treasurer of Gorakhpur branch, for vote of thanks for these webinars.
Yes, sir. Sir, your speech is very good and very knowledgeable, and we are also getting lots of knowledge and lots of things are which are got forgotten, but now I think now it is remind, and we are now think and we can invest in the right way and take a right decision or take reasonable steps. So thank you so much, sir. Thank you. And your deliberation is, sir, very good and very knowledgeable to all of us. So
Thank you, sir.
on
Thank
behalf
you.
of an ICI Gorakhpur branch and Professional Skill Enrichment Committee ICI, I would thank you and thank to all committee members and all other members who are participating in this event. Thank you so much, sir. Thank you, sir.
Thank you, sir. Thank you, everyone. Thank you,
Thank
Sambit ji.
you.
Thank
Thank
you,
you very
Vikas
much,
ji.
sir.
Thank you, Agredi ji.
Sir,
And
my
technical
sincere
support
thanks to
also.
our learned speaker, C. Nikhil Lakhani, sir, and Chairman, Vice Chairman of Professional Skill Investment Committee of ICI for organizing wonderful webinar to our members. A special thank to Samit Misra, sir, for wonderful support of these webinars. Thank you. Thank you very much, sir.
Thank you, sir.
Okay. Namaskar.
Bye-bye.